Good morning, everyone. Welcome to the Genghis Weekly Investor Briefing. We are happy that so many of you could join us for the final edition for 2020. We've been doing this for the last couple of months, and I'm sure for many of you, this is not your first time with us, so we really appreciate you for always joining us. This is not the end of the briefing. We are simply adjourning for the rest of 2020. So I hope you'll be able to join us when we resume in January. We will send out details of the same. And in January, we're going to start on a very exciting note when we kick off the Genghis Playbook for 2021. If you've been attending this session for the last couple of weeks or so, you've had us refer back to the playbook. So the playbook is a document that we issue at the beginning of the year, created by our research department, that really gives a very holistic view about the markets for the coming year, expectations, and inside the playbook, there is the much anticipated Genghis stock portfolio. So 2021 is going to start off on a really high note. But back to the business of today, we are, as always, glad to see Churchill and Gerald. Gerald is going to take us through the equities segment of our financial markets in Kenya. I'm sure there's been a lot of movement as we drew towards the close of the year and as the festive seasons kick in. And then Churchill is going to talk to us about the macroeconomic landscape, about debt, and then also about fixed income, that's treasury bills and bonds. Our sessions have always been interactive, so please feel free to use the Q&A section of your tab. Please channel all your questions through that particular portal so that we are able to curate the questions and answer them as we come to the end of the session. You can also use the chat function to share any comments that you may have, and our panelists, Churchill and Gerald, we'll tackle them at the end of the session. So let's kick off. Gerald, over to you. Thank you so much.
Thank you, Damaris, and good morning all. Let me share my presentation. Okay, yeah, so we can begin with the recap of the equities market last week. So a bit of some weakness. We saw the NASI index down about 0.3%. And then the 20 index down about 1.6%. Definitely this follows what we observed across the week when most companies, especially the banks, were announcing their results. So across the board, from the results, basically negative growth in earnings, and also for most companies issuing profit warnings. This definitely reflected in the performance of the indices during the week. So turnover was up about 6.6%, so fairly steady over the recent about 3 weeks. It has been holding at the 2.1 billion, which is quite low for compared to the weekly averages we usually see from the market. So top gainers, Kabasid, Everready, TPS. I guess most of us already know about the Kabasid transaction with BOC. So that is one of the key information that moved the stock. And then top losers were KPLC, SGL, and Kenya Orchards. I think from KPLC, we saw it trading at almost all-time low, about 1.4 shillings. Then the top traded were the usual Safaricom, Equity, KCB, BL, and BT Kenya, basically the blue chip companies that the NSE, not much change on that angle. So for top losers, note Standard Group. I think for 2 subsequent weeks, we've talked about taking profit on Standard Group. I think it was from last week, I think it was up about over 30%. So it is good to see that some of the investors were looking at booking that profit that Standard Group has basically marshaled over this quarter so far. In terms of foreign activity, participation came down to about 62%, about 78%. And then it was basically net outflow. So most foreign investors were selling out of the market, and it was spread across most of the stocks. I think if you look at the spread of the trades across from the foreign end, mostly exiting almost all the banks last week. And then EABL and BAT while still accumulating Safaricom now for almost 2 months. From the foreign end, yes, we talked about the participation that came down to about 62%, basically accumulating Safaricom for almost 2 months now on a consistent basis, but they were exiting most of the banks last week, and also EABL and BAT Kenya. So across SSA markets, I think on average, it was quite steady, 0.1%. Week on week, that is, but our indices locally were basically down. So the others, Nigeria and Botswana, were slightly up, but on average, we can say that there were quite some steady markets across SSA. Market PE currently trading at 10.7 times compared to the African average. So within spitting distance of the African market. And then yield 5.3 on average across SSA markets. We are trading at 4.7%, so still within those averages. For our trading ideas this week, remember we are still long term. I think the market where the market currently is trading at multi-year low levels, still having very good opportunities for most of the blue chip companies. But this week, our eyes on Kengen. I think we saw last week the price coming, a lot of some price weaknesses, almost closing on 52-week low. Then if you consider what was happening last week, there was a lot of news about going solar, and the effect on Kengen, the effect on KPLC, and then you also saw some news about Kengen, also considering entering the distribution segment. So, but the price weakness for me on Kengen was mainly because of KPLC. If you chart KPLC, you have a price chart of KPLC and Kengen, you find that the correlation, basically the movement between the two, are usually very tight. So and KPLC tends to be a leading indicator of where Kengen price will be. So because of the weakness in KPLC, mostly because of all that news that we had last week, so also Kengen following suit. But however, I think the fundamentals of Kengen are still quite good, and especially if they get into the distribution of power, I think that is another angle for them. Again, we talked about 2 weeks ago, we talked about performance FY20. Well, profits, I think they announced about, they talked about 10.5 billion shillings, quite good, a record high level for them. And then when you remove those one-offs, comes to about 7.5% growth in profitability. So I think it is going to be a good year for them. However, the key risk is about cash flow. Remember, Kenya Power has been having challenges, and this definitely is going to affect the cash flows of Kengen. So another key stock for us during the week is we are looking at DTB. I think from our earnings note that we did over last week, so some price multiples, a lot of weakness, and the price multiples are quite low. Basically, for a tier 1 bank, we're talking a price to book of about 0.3 times. But however, we think this reflects the quite low ROE of 8.5 times. I think most of the tier 1 banks are in the double digit side, but DTB has been hit quite severely by the current environment. Again, historically, the dividend yield of DTB has been quite low. I think the trailing dividend yield is 4.4%. So we think the upside is quite marginal, despite it trading at those multiples that could be considered as very, very attractive. Then in terms of corporate calendar, yes, today is the last day. of banking sector announcements. There may be some other companies that will still be announcing. I saw some companies also issue profit warnings, and expect as we head into December and January, more companies will definitely have to issue some form of communication in terms of how they perform for the full year. Then Cabasid, yeah, there's that transaction. The performance was quite good. The recent financial results, and they announced a dividend of about 7 cents per share. And then the books closure will be 9th of January 2020. So investors should take a keen look at that. So Churchill could take us through the fixed income and macro side. Thank you.
Thanks, Gerald. Let me walk you through the macro and fixed income segments. I'll start with a review of what happened last week, whereby there was the Monetary Policy Committee meeting for the month of November. As widely expected, the benchmark rate, thus the central bank rate, was retained at 7%. It's been there since end of April. The other things that caught our eyes from the policy statement was the private sector credit growth for the 12-month period up until October was at 7.7%. But having said that, just looking at what has been the actual net increase in private sector credit stock between April to October, that was around 119 billion. And compared to last year, same time, same months, it was around another 137 billion. So what we are seeing is that, yes, in as much as there's been 1.25% reduction in the benchmark rate, at least to contain COVID-19, that is the March MPC reduction of 1%, followed up with the 0.25% reduction in the April MPC meeting. We haven't seen a robust private sector credit mediation, and that is also related to the numbers. So our sentiment and our overall view on the headline number of the 7.7% is that this is just a base effect of because of the comparison of last year vis-a-vis this year, but nothing that is quite telling us that there's robust private sector credit mediation. Of course, the other thing that caught our eyes was on the 46.5% of total sector loan book, or 1.38 trillion of all the loans have been restructured due to the measures that were put in place by the CBK, at least for the banking sector. So that is quite concerning. We are not seeing robust credit mediation, and what is actually taking place is restructuring of loans, either lower loan repayments or just stretching the maturity of any particular loans. That's what's been playing out in the banking sector. World Bank, in their latest Kenya Economic Outlook, they revised downwards the 2020 growth rate to -1%, between -1%, which is the baseline, baseline projections, and -1.5%, which is the adverse projections. Of course, this is majorly on account of COVID-19 and also the impact on some of the sectors. And in particular, what stood out in their report is that the impact of education. Remember that second quarter, for the 2 quarters, that is second quarter and third quarter, there was not education, or the education sector was severely impacted. No schools were operational during that period. And even the second quarter numbers showed that there was a -56% decline on the education sector. So that is one of the things that came out in the report. Absent the impact of education sector, the overall GDP could be in positive, but because of that impact, we know that the fourth quarter, when schools partially reopened with class 4s, class 8, form 4s going back to school, we are seeing that that is partially improving. But nonetheless, the impact on the 2 quarters, on the second quarter, third quarter, is heavily weighing upon the growth projections for the current year. Last week also we had public sector hearings. This is basically on the upcoming budgets, next year's budget, and also over the medium term. So a number of 9 broad sectors were presenting last week, and of course there was the launch was opened by the CS for National Treasury, and there are some other presentations from the Ministry of Planning. And one of the things that came out is that there's a post-COVID-19 economic recovery strategy. So ideally, this of course preempts that COVID-19 will be somehow ending sometime end of this year or mid the current financial year. Might not be the case, might be the case, it's anyone's guess. But having said that, it's quite an ambitious strategy. It will be formally be launched mid next month, just to look at ways of how Treasury can be able to rev up the economy, be it through some of the tax strategies or even some targeted sectors, at least to uplift the economy. And one of the things that we are still not agreeing with that is the impact, or rather the reversal of the tax relief measures that have been put in place, at least to cushion citizens against COVID-19. The reduction in the corporate tax, the reduction in the pay as you earn, the VAT, value added tax. So what, and this is basically coming up from a president's speech, or rather directive, during the 28th September conference that had a number of players. So what came out from that conference was that as from 1st of January, the tax reliefs that have been on the corporate income tax and also the pay as you earn will be reversed back to where they were. And for the value added tax should be reversed by 1st of July. But we are quite questioning how those directives, particularly for the tax measures that are expected to be reversed on 1st of July, 1st of January, will take effect. This is coming because we know that all these directives, they are not roadside pronouncements. They have to go legislative process. And we know that by the end of this week, National Assembly is proceeding on a 2-month leave or recess. So what that means is that as it stands right now, come 1st of January, we'll still be having the current tax relief measures, as opposed to what even had been announced by the government, and even what Treasury is foreseeing that come 1st of January, there'll be a reversing of this. And on the other side, we know that our National Assembly has this populism skew, whereby, if I may take you back to Finance Bill 2018, whereby there was the proposed increase on where there was the proposed introduction of the fuel tax rate. Initially, it was pegged at 16%, but eventually it was reduced to 8%. But there was a bit of some pushback by MPs. That also last year, Finance Bill 2019, whereby even parliamentarians were not comfortable with the overall repeal of the upper ceiling of the interest rate cap. So all this is telling us that there's a populism skew amongst parliamentarians, which we don't think that in the current environment where the risk of COVID-19 reinfections is still on an upward trajectory, that this is the best time that even MPs might even revert the tax relief measures as they currently in. So point is, come 1st of January, whatever is still in place will still be in place, unless now it might be reintroduced, but that will be once Parliament come back from their 2-month recess. That should be mid of February. Moving on to this week's calendar, today we're expecting two key economic releases. That's the inflation rate for this month. Last month it was at 4.84%. It backed the disinflation trend. By disinflation, I mean that from the months of April up until September, the inflation was on a decline. But now for the inflation print for the month of October, it now somehow went reversed that trend. So it was on an increase. So today's number will see whether last month was a blip, or we are in an inflationary trend, albeit on a gradual pace. Unemployment rate is for the third quarter is also expected to be released today. The last print that is for the second quarter, that was a doubling in unemployment rate, 10.4%. So that this print will also be interesting to see what really happened, or how bad was third quarter, or what a recovery happened in the third quarter, if at all there was a recovery. Finally, the PMI by Stanbic to be released on Thursday. The previous print was a historic 59.1. Any print above 50 shows that there's an expansion, or there's a positive exuberance amongst the private sector players. Moving on to the fixed income, on the T-bond segment, we saw an increase of 19.2% week on week to 15 billion that was traded on the secondary markets. Most of the trades were majorly on the infrastructure bonds. These are attractive. They don't pay. They don't attract withholding tax, and also on the 20-year fixed rate bonds. Those were the most heavily traded bonds last week. T-bills had a performance rate of 64.3%. That was 15.4 billion of bids that were received by CBK. Just looking at how yields have transformed from their mid-July lows, I've seen that it has increased on average of 0.75%. This is across the board. And in the quarter, we've seen an increase of 0.43%. And moving on to the liquidity trends, this basically tells us the uptick appetite of even the investors to take upon any upcoming issue, or even the appetite regards to the secondary market. Right now, the market is actually eyeing or timing the announcement of next month's primary bond issuance. So the liquidity trends will tell us whether whatever amount that CBK has put on offer will be taken up by investors. So in terms of interbank, we saw it edging up slightly, 0.47% to a weekly interbank rate average of 3.48%. So basically that tells us that there was a tightening in the interbank market. And in terms of open market operations, it was basically tilted towards the central bank coming in to mop up the excess liquidity. That said, this week's what was sought was 45 billion compared to 85 billion that was being sought out last week. So that is telling us that the quantum, or rather the level of liquidity in the market, somehow has been gradually tightening on a week-on-week basis, just looking at the quantum of what is being sought by the central bank. CBK accepted 17.2 billion bids, which were which was the amount of bids that were received by the market. In terms of net domestic borrowing, currently we are sitting at 281 billion. We are ahead of the curve, just looking at it on a prorated basis. In terms of domestic borrowing, right now, against the revised target of 600 billion, we are sitting at close to 47% of that target. Finally, week's trade, we're still looking at the FXD2 2013-15 FXD for new initiates FXDs, now short form of fixed rate bonds, which is different from IFBs, which are infrastructure bonds. So this is how the government names the kind of bonds that are on offer. So we are looking at to buy at yields between 11% to 11.1%. Basically, improved liquidity on the paper. Following this month's auction, we saw that the outstanding amount in this paper has gone up to 66.1 billion. And we expected that the price will gradually go back to its pre-auction level, which was around 11.025%. The auction price was auction yield was 11.445%. Pre-auction 11.02%, but last week we saw it ending at 11.09%. So we've seen a gradual reversing back to pre-auction levels. Against last week's yield price, which was 11.09%, we know that this paper has a coupon of 12%, and based on that, whereby the yield is lower than the coupon rate, the clean price is higher than 100. So 100 is now seen as the base. So for every 100, the clean price with a yield of 11.09%, that's 104.47. So for instance, if you want to purchase, say 100,000 of this bond, you'll have to pay a clean price of 104,470. But this paper, because it has a coupon rate of 12%, it pays semi-annual coupons every 6 months. So the last payment was on October 19th. The next payment is in April 19th. So the accrued interest between the last interest up until last Friday, that was 1.38. Come 19th April next year, it will pay an investor 6 shillings for every 100. So basically the accrued interest is that portion of interest that has been earned since the last coupon payment. So that comes to 1.38. So the dirty price is basically the clean price and the accrued interest, and that's giving us 105.86. So for every 100,000 that an investor wants to get inside this bond, so they'll have to invest 105,860. And for every 6 months, they'll be receiving 6,000 up until its maturity, which will be in 2028. Let me stop there and invite Mathew to walk us through the global markets. Mathew, over.
Right, thank you so much, Churchill. Sharing my screen. A very good morning, everyone. And let's delve a little bit into the global markets. And as usual, I will be looking at what I can share, some insights about the Forex market, and then we move on to the week ahead. So I want to speak about market cycles. You realize that we are in a period where we have the markets contracting a little because of the coronavirus and really threatening some sectors of the economies in the world. And as well, now we have very crucial events again in the US, the elections. That transition is very, very important and remarkable when it comes to the global markets. And also the other, on the European side, again, the Brexit is still very important. So I want to delve into market cycles. When you talk about the market cycles, we're speaking about the swinging of the global markets up and down. And this can be represented on a small chart, a small time frame like the one of 15 minutes on the MetaTrader, or even a longer period, depending with the events which are causing the cycle. So just swinging of the markets. Now we have the expansion. When you have economic growth, the markets are booming, people are buying a lot. We have stability in the market. That's when you have expansion. We have market peak is where we have assets have been highly priced, and there's a lot of buying pressure. Everything is at the peak, and now that marks the beginning of a contraction. And when we have the contraction itself, sometimes depending with how long it prevails in the market, that might be a recession, right? But there are levels of that. We have weak markets at that time, tightening or raising of the markets. That's what represents a contraction, markdown, or a trough. When we have the markets at lowest, and that's when we're preparing for expansion. So these things are caused by global macroeconomic indicators, things like inflation, unemployment rates, economic growth, and interest rates. And when we're speaking about these macroeconomic indicators, of course, they are caused by things like, for example, when you talk about the economic growth and even the action of increasing or decreasing the interest rates, it's pegged to things like the pandemic or natural disasters. Or you see, there are times when we have bubbles in various sectors of the economy, and these are the things that lead to readjustment either on inflation or interest rates. So when all these factors come into play, we have market cycles. And the reason why I'm speaking about market cycles today is so that we understand the risk appetite and how you can choose your portfolio depending on the environment, the prevailing economic environment at hand. So risk off, we have risk off and risk on times when you're trading in the markets, and doesn't only apply on the Forex market, but even on the stocks, even what Churchill and my other colleague is speaking about. Yeah. So it's really very important. Risk off sentiment is when we have people downsizing on risky asset portfolios, and of course moving on to safe haven assets. We're talking about safe haven assets. These are the low yielding but low risk. All right. There are times of the year, or there are times in the global markets, or when you're trading on securities, that you don't want to really expose yourself because of uncertainty, high volatilities in the market. You want to hold on safer instruments like the US dollar, like the gold. Those are the precious metals, or even sometimes the bonds. Of course, when it comes to bonds, Churchill can speak more about that. Yeah. So that's when we are on risk off. Now, when you get to risk on environments where investors or even traders are looking on to buying high yielding assets or financial instruments, of course, there's higher returns, okay, and not very risky during that environment, because there's a little bit of stability and people can afford to risk. That is simply the meaning. And when it comes to risk on, people move on from the safe haven assets, now the US dollars. Now people start moving to other currencies from emerging economies, right? And trading stocks of smaller companies. That's when people are now ready to risk. And the global economic environment is very important. You need to keep watch of that, whether you're trading on the local stocks here at NSE, right? As Churchill again will advise you, you need to understand the global environment, what's happening, where do you focus on, which stock classes do you look at. The same case even when you're trading on Forex, you want to look at the segments, the market segments in terms of we have the companies or stocks on the consumer goods side, stock companies on the energy side, those kind of things where we have utilities. So you need to readjust your portfolio depending on the market cycles. That's the main reason why I just made sure I touch on this. So currently, just to clarify on this, during the months of, as from March, when we had the coronavirus hitting hard, March coming to April, all along, all the time, up until now, where we're hearing about the vaccine, though the vaccine is coming when we are on the second wave. During that period, people were on risk off. Risk off meaning that people don't want to take, investors and traders don't want to take a lot of risk, right? They're shifting from the highly volatile and highly risky assets of those emerging economies, currencies from the cross currencies from the minors and the exotics, going on to majors, and still reducing the positions, having very tight risk management tools, right? Currently, it's like a little bit of normalcy is coming in, of course, as the volatility on the side of the leadership in the US maybe coming towards an end, not really an end towards a settlement. Right now, we look at the General Service Administration. It's like they have the go-ahead to start the transition from the Trump administration to the Biden administration. Again, that's when it's a signal of a little bit of stability as they're looking forward for to see the policies, the monetary and the fiscal policies, and even the stimulus that might be coming from the Biden administration. So at that point, people are moving on to a little bit of stability, and that might signal a little bit of a risk-on environment. And that's why you'll see that safe haven assets now are getting some sell-off as people look up to investing on riskier financial instruments. And that's that. Let's move forward now and check on the week ahead. Of course, last week, because of the changing sentiment on the markets, people moving on from the risk off to the risk on, the Dow Jones and the S&P 500 closed at a new record highs, soaring higher, and of course, gold getting some meltdown. Of course, oil because of the demand and the optimism of improving economies and maybe consumption of the fuel. Again, we had the US oil or the West Texas Intermediate rising, though currently it's at a consolidation. Last week, again, the news of the vaccine brought a lot of optimism, but on lifting the markets, a little bit of slowdown. Yeah, sterling or the US dollar cruised higher, of course, on the speculations around the Brexit. We are coming towards the edge. This thing has been going on for like 4.5 years. It's being speculated that it's taken even more or close to the civil war. So still something that we need to keep watching on. That's what was happening last week, still going on up to this week. Again, to repeat myself, on the General Services Administration, it's like it's not like it's like, but it's happening. The transition beginning from Biden to from Trump, sorry, to Biden administration. We've even heard of rumors of Biden naming a few people that might be taking offices there. Key events this week would be seeing, you've seen already on the Chinese manufacturing, right? And going ahead, we have the Australian dollar on Tuesday. A lot of news here on the European side, Swiss franc, Australian dollar, US dollar, especially on the testimony of Jerome Powell, the Fed chair, and the US manufacturing PMI. Those ones are really going to affect the pound, the USD pound, and the gold as well. Really very important. Traders need to look at that. On Wednesday, we have important news on the dollar, both on the Australian side and the USD, and of course Thursday and Friday. Friday is really very awaited. We have very awaited events there. The non-farm payrolls, looking at the employment outlook in the US, really very influential in the market. Products to watch, of course, the oil. Remember, people are getting optimistic about the not really reopening, but at least an excitement of the economies as the vaccine, the news of the vaccine are coming up in the US, in the Europe, and that's what has really caused the spike or a rise of the US oil, though it's currently trading at the around 44 area, and you see some consolidation there. Of course, trading above the moving averages. And what we're looking into is to see whether these prices are going to break above the 46.2 levels, right? If it breaks above the 46.2 levels, we might see testing the highs of February. Yeah, the highs of February this year, that's 48.75, right? Depending with how the vaccine gets along. If the prices retest the moving averages and break below, because we have the OPEC meeting coming up, and of course they're going to deliberate more about the supply cuts, whether they're going to roll it over. That's really important for us to keep watch on. Otherwise, very importantly, this is being driven by the demand. and of course, how the vaccine gets along. So keep watching on that, the US oil. And again, on the Brexit deal, before I forget, there's an offer here, Brexit special, very low spreads on the Euro 50 and FTSE 100, very low spreads there. So you can take advantage of that as we await the news and see how it's going to unfold. On pound USD, again, along the Brexit talks, you can see that it's bouncing off the 50-day moving average, the 50 moving average, and getting some support there. Might go to test the levels of 1.3400, right? And beyond that level, you might see it moving to the resistance levels of the year, right? 1.348, really very important. If it slips below the 1.329 support, below the 50 moving average, you might see it testing the lower levels of 1.3031 before moving even lower, depending again with how the non-farm payrolls come out and how the Brexit talks bring up. Moving forward again to the gold, really, really important to speak about the gold because it's been a safe haven asset. And right now, as people are getting on to the risk on sentiment, people are moving now from the safe haven assets, moving on to invest on riskier assets. Of course, last week it just tumbled from the 1850 levels on Monday, broke even below the 1800, and now it's playing around the 1775. If that one is around the day moving average of 200-day moving average, right? If it doesn't recover from that level, might see a downward move to the 1700s and maybe even 1660s, 1630. Again, that's one dependent on how the news on the COVID-19, how the vaccine goes, and if the markets are going to pick up so that people can proceed on getting to the risk on markets. Of course, we don't know whether this will happen this year, but people also, or traders will be waiting to hear about the stimulus if it comes up, but that one is something we'll be talking about maybe with getting in with the switch of the administration, maybe to the Bidens, and might see if the stimulus might be coming up and the policy should be coming up again, is something that really affects this yellow metal. Now, companies to watch this week, of course, announcing their earnings. We have Zoom, Salesforce, CrowdStrike, Marvel Tech. Can again keep watch on that. That brings me to the end of my part. Over to you, Damaris or Churchill.
Thank you so much, Matthew. We found it as insightful as ever. Thank you very much. So let's start tackling the questions. Allow me to tackle the ones in the Q&A first. We have Mark Booney who's asking, and this is to you, Gerald. Centum reported a loss that seems to have shocked most people. Would you say it was COVID linked or not? And then we also have Kamal who's asking, what's the market outlook on investment in the following counters? That's Safaricom, COP, and Centum. And Mark also back with another question. He wants your views on TPS as a long-term investment. I also noticed a chat with Chege and John. Chege was asking, or rather Chege was stating that he's indecisive between adding KCB or Safaricom to his portfolio. So he wanted your 2 cents on that. And then John Musembi rightly noted that any of the two are great for long-term investment, but that's just his own opinion. So maybe you could weigh in on that particular conversation. Those 3-4 questions, Gerald.
Okay, thank you, Damaris, and good questions. Yeah, I think for Centum, I would say the biggest part of decline in profitability was mostly due to the fair value gains that we observed in the prior year. Remember, they did some exits worth about 12.5 billion from the sale of Almasi, from the sale of Nairobi Bottlers and in Africa. So there was quite a huge boost in the prior year from those sales, and for this period they didn't have any exits that they did. So when you add that effect and then the environment that most of the companies within the group are operating in, then you observe that kind of weakness. Safaricom, I think the business, the price, I'll start with the price. I think the price has been very, very stable. Actually, I think it's one of the outperformers this year. Despite the decline in profitability that you observed, I think the price has stayed at above the 30 shillings level. I think that resilience is going to be carried forward. So we may not see significantly lower price than where currently it's trading at. But from a valuation standpoint, I think the upside may be very, very marginal, despite the business being very solid. For the upside, I see a very marginal upside, at least in the short term. Coop Bank, yes. From what we have seen so far from the bank, I think up to half year they were a bit cautious in terms of provisioning levels. I think compared to its large peers, Equity Bank and KCB, their provisions were quite conservative. But in third quarter they increased quite a bit. But I think from a comparative angle, I think they still lag the other two banks in terms of provisioning. So basically, that would mean that despite being the bank operating within the same environment as KCB, for example, and Equity, the management may be a bit bullish in terms of the performance of NPLs compared to the other management. So it is likely, for example, that the provisions might increase again substantially, especially during the quarter, as they did in the third quarter, so that at least to align with where the other large peers, Equity Bank and KCB, are currently at. I think for them, as at third quarter, the provisions increased provisions by about 100%, but the other two are about 200% and 600%. So it's still quite some lag. However, I think the price to book is about 0.8. I think 0.8, 0.9. I think I would like it a bit weaker from those levels, considering that KCB, for example, is at a price to book of 0.9. So I've talked about Centum and Safaricom Corp. Okay, yeah. So KCB or Safaricom. Yes. So I think both businesses are solid. As I've mentioned, Safaricom, the upside may be a bit limited from a valuation point of view, but I think KCB is quite attractive at where it is at current level, 0.9 times price to book. I think for that KCB would have a much higher upside compared to Safaricom. But if you are a long-term investor, let's say 5 years, I think both businesses are still a good recommendation at where they're currently trading at. The other was about TPS Arena. So for this industry and the stock, we usually don't actively follow the stock, but of course you know that TPS Arena will be affected by what has been happening and the disruption that has been happening in the hospitality industry and hotel industry. I think it is one of the biggest, it is one of the industries that has been impacted severely by the pandemic. So we would not expect that its performance would be quite good compared to the other industry. So since we don't actively follow this, I would not be the best person to give you a very detailed view of how the business is expected to perform, but the trends of the hospitality industry should give you some direction of how the stock is going to perform. So Damaris, back to you. I think I've addressed most of the questions.
You have. Thank you. Thank you very much for that, Gerald. So I want to go into the chats. I know Mark had asked about buying Family Bank shares, and I responded that it's ideally you would buy them directly at Family Bank Towers. So I hope you took note of that. And anyone who raised the issue, I've followed up with the client relations team. So this is to Catherine and also to another gentleman who'd asked a particular question, and Beatrice, I mean. So I know there was a question here for Churchill. Have found it. So Churchill, David Kanye asks, why were there two bonds heavily traded? That is the IFB and the 20s. And he wants to know the reasons behind this particular interest in those particular bonds. So Churchill?
Thanks, Damaris, for posing those questions. Thanks, David, for bringing them. Basically, last week, infrastructure bonds, those are the IFBs and also the 20 years, were the most heavily bonds in the secondary market segment. For infrastructure bonds, particularly, it's just speculation. This basically comes from the market perception based on Kenya shillings movement. Just looking at Kenya shillings movements in the course of the month, it has depreciated 1% against the dollar. So there's a market perception that the December primary bond issue could be an infrastructure bond. I'm saying it's a perception because most market participants say that foreigners or offshore come in to to buy infrastructure bonds, and as they come in, of course, it's supportive to the Kenya shilling because of foreign exchange inflows. But the data doesn't support that, because you know that for August there was an infrastructure bond came to around 74 billion, but the foreign component of that was 620 million. But that said, this falls under this Pavlov theory. Well, let me break it down a bit, whereby there's this famous experiment of a dog being around lunchtime. Somebody comes and rings a bell, and then food is taken to the dog to eat. Goes like that, but ultimately the food is not brought to the dog with the accompaniment of the bell. So what the dog comes to associate with bell is that there's foods that comes to be. So I think at some point infrastructure bonds were quite synonymous with foreigners, but that is not the case. But that said, that is still what the market perceives, that because of the depreciation of the Kenya shilling right now, I think it's at historic lows, psychological level of 110 vis-a-vis the dollar. So there's that speculation that come December, at least to support the Kenya shilling, there could be an infrastructure bond issuance. So that could partly explain the increased demand for ISBs last week. For 20 years, those papers which originally were 20 years, of course, some of them are below that. We see that it's because that segment is not expensive. Looking at the demand right now, the uncertainty in the market, we've seen a series of longer tenor issues that have been put at the primary bond auction, primary bond sales. So, and right now, because of the uncertainty, people want to have shorter term papers. At least there's no appetite to go long. But because of that, you see that the short end of, or rather, the demand for the short-term papers has skyrocketed, and also the prices for short-term papers is quite expensive as opposed to the long end of the yield curve or the long-term papers. So there is a shift in demands to the longer tenor papers, which reflected in last week's trading activities. So top of my head, those are some of the contributing factors towards IFBs and the 20 years last week. Back to you, Damaris.
Thank you, Churchill. I don't know about the rest of you, but I do love Churchill's metaphors. Like, where else will you hear Pavlov's classic conditioning brought up in terms of investment? So thank you so much for that. Mathew, there's a question for you here from Patricia Mogay. She asks, a question on the USD Kenya shilling. Do you think this is a case of currency devaluation and the market is correcting itself, or is this due to post-lockdown effects? I know Churchill has talked about it just a bit, but maybe you could just speak to Patricia's question as well.
Okay, good question there, Patricia. I think with the Kenya shilling, USD Kenya shilling, it has to be more to do with the fresh coronavirus spike, because it's like we're on the second wave, and you realize that when the people really feel the shock of the markets again and slipping back to the pandemic, it causes several things. Number one, people start demanding the safe haven assets. Just like I was speaking about the risk on, risk off, and safe haven kind of things. When the second wave came in, people start to get again to the safe haven assets, and when they start demanding those safe haven assets, then you realize that the demand for those hard currencies is higher, and when their demand is higher, and then of course we have the Kenyan investors going to that side, then of course the weakness of the Kenyan shilling gets in. And number two, remember we had fresh lockdowns in Europe, and right now they're still in effect, all right? And you know that Europe is a strategic, sector, or it's a strategic region where the Kenyan horticultural sector, and even on the flower side, exporting a lot to that region. And with that now, and the reduction of the traveling, that one again reduces the inflows of the foreign currency here in Kenya. That one again affects or works to the low value of the Kenya shilling. So those are the things that are really affecting the Kenya shillings.
All right, thank you very much, Mathew. I'd like to go to Gerald again. Wesley is asking about short-term buys. I know recently most of our recommendations are on long-term buys. Gerald, do you have anything you could add in terms of short-term gains? Gerald is busy opening his impressive sheet to get us the answer. Gentlemen, is Gerald free?
Looking at the current market and
okay. I think we have a slight connectivity issue.
Hello, Damaris.
Hey, you're back. We thought you were concentrating hard on that question, but I think you're back. Go on.
Yeah, so looking at where the current market is trading at and why it is trading at those levels, I think there's going to be a bit of there's going to be a bit of volatility, because the environment is changing almost on a daily basis. There's surprises almost on a daily, weekly basis. So I think for a short-term trading strategy, I'd be very cautious recommending that. I think on a longer term outlook, you can be able to see a lot of value, a lot of where value is and where value can be realized on a long-term basis. But on the short-term basis, because there's a lot that is changing, I think I wouldn't recommend short-term trading strategies. However, I think Mathew has something good on the currency side and other commodities that could give you a short-term, some quick short-term gains. Thank you. Back to Damaris.
All right, thanks, Gerald. Churchill, we have a question from Lydia before I go the queue and answer Caroline Gavi's questions. Now, Leda is asking, Churchill, what's your outlook on the real estate going forward? The prices for houses for ready accommodation, not off plan. So Churchill, I don't know if we really do have commentary on real estate, but perhaps you could try and address some of Leda's concerns over here.
Thanks, Lydia, for the question. Currently, at least on the investment bank side where we sit, we don't actively cover real estate, but I'm sure that our other side of the business, that's the asset management, could have some a few insights on the real estate. I'm sure Damaris could, I think one of the webinars that is being directed by asset managers, I think one of them next year should be tied toward real estate, because I've seen a number of commentaries or questions being asked on real estate. But for investment bank, we're not the best place to tackle real estate, but asset management.
Okay, thank you, Churchill, and quite right, team. It's our asset management arm that would actually be able to talk about real estate, and we will organize a webinar in the next year. But speaking of our asset management team, perhaps later you could think about hopping onto our webinar. We have another webinar in 2 hours' time. It's covering the retirement benefits products, but I'm sure we'll be able to address a holistic number of questions. I've dropped the registration link on the chat, but I think if most of you probably engage with us on social media, so you've seen the details of that particular webinar. Registration is open, so you can still attend. It's going to be very interesting. To address Caroline Gabi's question, but I also brought in a team. Her first question was, what are the investments that I can get monthly returns? And secondly, where could I invest funds ranging between 300,000 and 400,000 now during this pandemic? Now, Caroline, if we are to ride on Gerald's commentary on he's not really advising on any short-term buys, if you think about the stock exchange, and if you think about fixed income, that's treasury bills and bonds, there isn't any that's going to get you a monthly return. My recommendation would be, if you're interested in Forex trading, you would consider the FXPesa platform, because that's a platform that allows you to trade and you're able to realize gains. But of course, that requires a certain amount of expertise, which we've talked about in the previous sessions. There were training courses, but that training program has since ended for the year. But if you go on YouTube, there are still resources that you could use for learning. But if learning in order to trade isn't something you're looking into, I would actually recommend that you look at other types of investment products. So I'm talking about things like a money market fund. Genghis Capital has a money market fund. It has a yield of above 10%. So if you're looking for a monthly return, this Helaimara, that's what you call our money market fund, you literally earn interest daily. So based on the daily yield rate, the money that you invest or put in this particular account actually generates money for you every single day, and you have access to it whenever you need. And for that amount of money, 300 to 500,000, that definitely fits into the threshold for Helaimara. I don't know if there's anyone else who has advice for Caroline, but that would be my 2 cents, to look at other investment products, perhaps, especially if you want to get consistent income on a monthly basis. So, gentlemen, is there something you'd like to add on? Okay.
Yes, Damaris.
Yes,
I think you have captured it quite well in terms of short-term and monthly return kind of investment. I think Helaimara and market products would be very ideal for you, because if you're looking at current markets, especially the equities market, there's a lot that is going to happen, especially the January period when companies start announcing full year results. So there's that cautiousness that is expected to extend for a couple of months as investors try to grapple with performance of most companies. And then money market, I think it's averaging about 10%.
Yeah,
I think that would be a deal investment for him and the current environment.
Yeah, true. Thanks so much for that, Gerald. I really appreciate the backing of an expert. So, Wesley, you're asking, is it 10% monthly or per annum? It's per annum. So the rates we publish, that the effective yield, the effective annual yield rates. Our rates are net. That means they are minus our management fee, but of course they're gross of the withholding tax that's payable to the government. If you'd like to have anyone who's attending who would like to have another conversation about asset management and our products, feel free to just contact us on info@genghis-capital.com or on any of our social media platforms. Just inbox and someone from the marketing team will reach out to you and will be able to explain further. Milka, the webinar registration is still active. I've copy-pasted the link again in the chat, but if you type in your browser bit.ly/Genghis PIW3, you will find it, or go to any of our social media pages and you will find the link to register. I think that brings us to the end of our 2020 session for the Genghis Weekly Investor Briefing. I want to say a big thank you to Mathew Kabeere of FXPesa EGM Securities. You guys are the best. You've joined us every single week for the past couple of weeks. We hope we'll be able to do the same in 2021 because people are definitely interested in learning more. So I think it's our prerogative as investment partners to actually share the kind of information that makes investing easier. So Mathew, thank you so very much. We really appreciate you.
Thank you.
Churchill and Gerald. Thanks so much, Mathew. Churchill and Gerald, you guys have been great. Churchill, I don't know where we're going to get our metaphors and mythology and things during this break, but we know you'll come back in 2021 even better and stronger. Gerald, you're always the star attraction. We're going to try and give you some competition in 2021, get people interested in other things as well. Talk about derivatives, talk about treasury bills and bonds, and talk about the global financial markets. But Gerald, thank you so much for always giving us great insights. Like I said at the beginning, we're going to start 2021 on a very high note. We're going to have the Genghis Playbook Conference, and you don't want to miss out our playbook because it's going to give you everything you need for the coming year. So thank everyone for all the compliments we're getting on the chats and for coming back every single week. We don't take it for granted, and we will definitely reach out to everyone when we are launching our 2021 editions. So that's a wrap. At some point this week, as usual, you'll get an email with a link to this recording. Please feel free to review, share, and hit us up with any questions you've had. So from the Genghis team, thank you. Stay safe. We definitely want to see you here next year. And happy investing. Thank you so much. Guys, have an awesome day. And attendees, I hope to see you in 2 hours' time. Bye.